Today, folks, I got two fascinating Canadian dividend stock focused stories to bring to you today. With first and foremost, like Pokemon cards, you got to collect them all when it comes to these Canadian banks. And we're going to talk about stuff I overlooked when I was reviewing their earnings yesterday when it comes to the mortgages, their outstanding variable rates, how much are they being impacted by defaults, and a few other details. But I also want to talk about a stock called Alimentation Couche-Tard. This runs gas stations, Circle K's, Max. You've probably seen them. It's been one of the best performing Canadian stocks of all time. I've had endless concerns about them, yet they blow out and have just overblown my expectations through leaps and bounds. So we're going to discuss those two stories, and that's a conversation you'd appreciate. Hit that like button because we've also been buying the Canadian banks today. We've been talking about it in our chat groups. I picked up some shares. The boys picked up some shares. And if you want to join the boys, consider hitting that Patreon link and joining to talk with me directly and about another 50 odd or so 6-7 figure investors. But taking a look before we get into the stories, the heat maps, the Canadian, US markets, where the performers have been. It's been a bit of Abu Dismal. I love when the market pulls back because this is where the opportunities lie, but computer and telecommunications, Shopify, Constellation Software, and even communication services like Bell and Telus have been some of the best performers this week, along with some of the basic materials, but all in all, we know it's been not the best week. I mean, the S&P 500, the best performer of the bunch this week has been Tesla. Of all the US companies, even Nvidia had a blow off top after earnings going up like 5 to 10% and completely gave back all those gains because of just the overbought nature of the AI hype that's taken place here. But all in all, it's been mostly a pullback week for most companies because even though they're green, the last few days have been mostly red. It's got to remember they had a lot of rallying at the beginning of the week. But taking a look at the Canadian markets where I want to focus, the top traded companies, obviously the banks. We're going to talk about Toronto Dominion. We're going to talk about Royal Bank and Alimentation Couche-Tard. These stocks have been some of the hottest, most discussed companies over the week here. And Toronto Dominion Bank continues to pull back. The company is doing the right things, though. They're introducing like a massive share buyback program, which I think the stock is a buying opportunity of a lifetime. As mentioned, this is the highest dividend yield they've paid damn near in 20 years, with the exception of the pandemic. And they've had other bad news recently, as basically the U.S. has been probing them on money laundering. I guess they haven't been doing the best job at keeping money launderers out, and they're likely to face some penalties from that. Nothing I don't think they can bear. It's the second largest company in Canada. It's a huge company next to Royal Bank. Now, how is Royal Bank performed better from a balance sheet perspective? Like mentioned, this is a pure focused Canadian bank. So what ends up happening when 1 million people come into the country last year and immigration is just exploding to the point where it's screwing up the rental and housing market? Well, the banks benefit greatly. And Royal Bank has proven that by showing much better than expected net earnings. They've had great revenues and the stock is still trading down. There's huge buying opportunity here as well. I think Royal Bank's probably one of the best, one of the largest holdings I've been picking up here. Now, you have to contemplate one thing when it comes to these residential mortgage portfolios, and that is if you believe people are going to default on their mortgages, they have two options. When they come up for renewal and they can't afford the rate, they're either going to put it up for sale themselves or the bank is going to take it from them and they're going to force them into a sale. Now, the only way this is going to become a huge problem is if one thing happens. There's no one there to buy the home and housing prices start to correct dramatically, and that is exactly what we're not seeing. I know people right now that can't afford their mortgage rates. They put their homes up for sale and guess what? Somebody bought them. Somebody bailed them out. And for as long as that remains the case, no matter how many bad mortgages these banks have, it's not going to negatively impact these loans because they have to lose the full value of them on the resale value, right? And we're talking about a total of $398 billion for Royal Bank's mortgages that are insured and another $333 billion that aren't insured. And it's funny because the 90 days past due is 13 basis points on the insured ones and 11 basis points on uninsured. The uninsured folks are actually a little bit stronger, but these are very nominal. They're ticked up slightly, but very nominal, and it's split pretty evenly between the greater Vancouver area and the greater Toronto area. What's really intriguing to me is the remaining mortgage amortization is 24 years, and the original term has been 39 months, and the remaining term is sitting at about 28 months. These are the terms that are going to come due. So, I mean, you're talking about almost 3 years for a lot of these loans before they actually are going to get hit from the actual higher interest rate environment. But right now, 30% of the portfolio mix is in variable. So these are the people that are already getting slaughtered. And if they haven't lost their home already, I don't know how many of these are truly struggling to make these payments, but they're making the payments. We're not seeing massive defaults, right? Fixed rates sit at about 71%, so that'd probably be on the average duration here. Most of them being detached homes, which are very expensive compared to condos, which makes sense because from a dollar perspective, it's obviously going to be highly exposed to the detached level, right? But also taking a look when it comes to TD here, what I want to take a look at is the real estate secured lending, and we can see that 39% are variable, which is a little more concerning. so TD has a higher impact, and this is just the Canadian side of it as well here, but less than 1% of the overall portfolio is uninsured and has a bureau score of 650 or lower, which is very intriguing to me. And they also have an average bureau score of 793, which has been stable quarter over quarter. Nothing here screams that things are going to collapse, right? And if we also take a look, which is very intriguing, into the economy, you can go through the Canadian personal banking, see how many of these are auto loans and credit cards and other personal. You can also see the commercial banking related to the financial sector, metals and mining, oil and gas. When you buy into these banks, you're getting full exposure to the entire Canadian economy, and you're making money off everything from real estate to the mining sector to oil and gas. That's why I'm saying when you own the banks, you basically own the entire Canadian economy. And if you bet that the banks are going to go bust, you're not going to worry about your money anymore, because it means most of the economy is completely bankrupted, right? But that's the banks. I'll pass the question off to you. I'm buying them. Our chat group is buying them. I think they're incredible. Now, talking about Alimentation Couche-Tard. Now, I've always hated this company, but that doesn't mean you should. I'm going to talk about some of my concerns. They have earnings coming up, and this stock has just crushed it by leaps and bounds. I mean, the stock's up 15,000% since inception. It's up 127% just in the last 5 years. The dividend's kind of like 14x, going from 1 cent 10 years ago to today at 14 cents. Keeping in mind the dividend, I think, is really low right now at somewhere around 0.8%. But nonetheless, getting into this, guys, they have 14,400 total locations between kind of a mixed-use gas stations and obviously Circle K's, these convenience stores. And the reason I hate them is because I don't shop at them. Convenience stores are where people go to buy lottery tickets and overpay for chocolate bars. That's the way I've always thought of it. I'd rather go to the dollar store. I love the dollar stores as a stock. It's also been recession proof and has performed very well. This is globalized primarily in the US and Canada, however, but I want to talk about some of the future expectations here, because even with this insane growth rate and obviously, population growth in major cities, taking advantage of, the margins on some of these higher priced items. And I'm surprised they don't have better profit margins, because right now their profit margins set at 10%, which is also concerning to me, because if they see a 10% hiccup in their revenue, it could also crunch some of their margins a bit. I mean, if they see, they don't have a lot of room to play with, but they've been very good at taking advantage of this kind of business model of people getting gas and needing to get cigarettes and just picking up small things, right? But right now, it's like a 50-50 split between fuel and merchandise and services sales, almost pretty much evenly from the gross profit and revenue perspective, which is very intriguing to me, because they have to do this massive pivot that's about to come up, and they're starting to. I mean, they've installed 1,600 EV chargers at 325 stations and 10,100 home chargers and workplace chargers in Scandinavia. So they're really trying to figure out how they can take advantage of this pivot, because by 2030, 2035, there will be no more new gas cars sold. There'll be about another 20-year cycle of gas cars kind of, remaining before they kind of get scrapped and they become kind of prehistoric, museum, old timers like me might still own them kind of a thing. But completed localized pricing across networks and working on data-driven assortment and promotions. They're trying to get into fresh food, which we've seen. If you've been to these stores, they're trying to offer pizza. They got like coffee shops in there now. They're doing everything they can to diversify away from that kind of overpriced Circle K business. But the problem is can they pivot enough? They're claiming that longer dwell times in relations to chargers have led to an increase in traffic in our stores and ultimately in a positive lift in sales. Because when I think about charging, especially here owning a condo, I see chargers down in the underground parking. When I think about charging, the point isn't to go out to charge. The point is to get home at night and, like my phone, plug it in. Or if I want to go to the mall, hey, maybe I'll plug it in while I'm at the mall. I don't think about going to a gas station. I mean, the whole point was to get away from them, right? So the question is can they pivot and actually see excelled growth in this kind of new business model over the next coming 20 or 30 years? That's the question that I have for myself, because they've been trying to pivot. You can see them pivoting. They know if they can get into some perhaps like little coffee shop deals, they can give people a reason to come when they're driving on maybe perhaps longer trips. But the thing is it going to convert well? Is it really going to convert that well? They're saying that it is, but is it? I mean, they're talking about Scandinavia. I mean, we're not talking about the Western world here, right? Which again is still growing. There's still a lot of use for gas. I'm not saying this company's going anywhere anytime soon. The last thing they talked about was getting into fire and flour. They were partnering with some of these MJ retail stores, which are highly competitive as well, right? I mean, we're talking about, you go to Toronto, you see them on every block. I don't know if they can actually perform well in this sector, considering they don't update on it. So I'll be listening to the earnings just to get a broad view of a lot of this, because this was the last update on that kind of expansion, which anyone that's been getting into the MJ business has got slaughtered. I mean, name one MJ stock that has actually excelled. They're far and few in between, right? But outside of that, I'll pass the question off to you. I'd love to know what you think about these stocks in that comment section below.